The main event of the week, the announcement of consumer inflation data for July, added to the optimism. The actual results were better than expected. Price growth is slowing, which means that the Fed's efforts are having the desired effect. At the next meeting, in September, the Fed will either pause or begin a gradual reduction in interest rates. The first scenario is more realistic, as the futures market shows a 90% probability that the Fed will pause. And even if an early pause could lead to a new price increase, it is unlikely to scare the market too much. Hi, this is a quick review from Ivan Kompan, Edinburgh Business School analyst.
In the long run, it is probably too early to say that inflation has been finally defeated. We have months ahead of us when the comparative base will change, which may formally increase inflation. Also, history shows that when prices jump by more than 8%, it takes, on average, more than 4 years to return to the average 2%. Also, the dynamics of oil prices and the active reduction in production by Saudi Arabia, which wants to keep prices high, are a significant argument that the fight against inflation is not over.
The quarterly reporting season continues and is going better than expected. Already 85% of companies have announced their financial results. On average, profits fell by -5.2% year-on-year, instead of the forecasted -7.5%. Revenue grew by 0.6% compared to the same quarter last year, instead of the expected -0.4%. Despite exceeding forecasts, the results are the worst since the third quarter of 2020.
The bankruptcy of American banks in the spring has been forgotten, but Moody's reminded us that problems in the financial industry remain, downgrading 10 mid-sized banks and announcing a downward review of U.S. Bancorp, State Street, and Bank of New York Mellon. So the question of the financial sector's sustainability is very relevant, as the Senior Loan Officer Survey indicates a decrease in lending, and Fed data shows an increase in car loans, student loans, mortgages, and credit cards.
Worrying news comes from China. Despite the end of the quarantine, there has been no economic takeoff this year. Weak macroeconomic statistics as well as demographic problems point to the beginning of a period of very slow economic growth. For example, the country's sixth largest developer, Country Garden, expects a loss of $7.6 billion in the second quarter, with a drop in sales of -35%. This could lead to a default on its bonds, and Moody's has already downgraded the developer's credit rating by 3 points to Caa1, reflecting significant risks associated with the issuer's ability to repay its debts. In the end, communist ideology is likely to help the country overcome the negative aspects of capitalism, but the turbulence may be strong.
What is the result? Investors' reaction to the better-than-expected inflation was mixed, a half-day rally on Thursday, followed by a rather rapid cooling of sentiment. It would take more than slightly better than expected results to push the heated market even further upward. As you can see, corporate results in the second quarter are the worst in 3 years, while at the same time, the valuation of S&P 500 stocks is higher than the average over the past 5 years. Sooner or later, this gap should disappear, or at least narrow, either because prices fall or companies' results improve. Given the tight monetary policy, high interest rates, difficult credit conditions, and other challenges, the latter seems to be a rather difficult task. That leaves us with the first option.
And finally, we would like to remind you that the information you have just listened to is not an investment advisory. Remember, investments in the stock market are always tied up with financial risks. So be careful and cautious. Like and subscribe to our YouTube channel. See you soon.